I think this was smart. Here's why. It would have been a really big distraction because we looked at, if you look at the 3x, the stocks they were 3xing, we found that 350 instances over the past 5 years where the stock swung by more than 33%. Well, that's like one termination event every week or two. So it would have been a constant nuisance. And at that point, it's going to stay in the industry. You can handle one a year, but you can't have like one a week. It's just like, it's a little too much. It's like, so this is good. Where I think the loophole is, and the industry should thank their lucky stars, is allowing 2x stock ETFs. Because honestly, you can just link that 2x to some crazy volatile stock and have something that's effectively like a 10x or 12x S&P 500. So
in terms of the actual risk.
There's already a backdoor. It's plenty. We should all be happy with what we have. I think this is good, and I'm pretty liberal.
Yeah, I'm with you. I think I'm not against leverage. I just think that this is a really bad way to get leverage. And like crypto figured this out. Perpetual futures are fantastic for anything that's got a number stream you want to put them on. Eventually we'll be able to trade those and that'll be fine. And people want to take 50x leverage and go bankrupt in a day, they can. So I'm with you on that front. It doesn't belong in an ETF wrapper on a regulated exchange. That's my take on it.
One real quick on this that's ancillary. There's been some pushback on like the swap costs of the 2x, but like I keep looking at this and I'll say, okay, TSLL is up like exactly 2 times. Okay, maybe it's 4 basis points off, but I just don't. Have you? I mean, do any of you see any issue?
That you found a rare one if it's that tight.
I did Nvidia too. I looked at the popular ones.
The MicroStrategy ones have been 5, 7, 10% off on big days. Like massive. Yeah. Go look at all the MST ones, the MSTR ones in November last year when they first came out. They were bonkers. They were all over the place. We had a couple of hiccups around April where a bunch of them went like 5, 10% off on an individual day. So like they can get really wacky. I think the financing costs under the hood, my only concern there is that they're not disclosed, right? They're not transparent. I think, Mike, you've been talking about this a lot. Like fee transparency is a real thing.
Yeah, I think that's my big. The leverage inverse. It's gonna ebb and flow. I mean, think of like what it did after the financial crisis. It blew up, got really big, and then it came back to life. The different market cycles, it's going to come back. And I don't have a problem with the product. I mean, for crying out loud, if we're going to allow us to bet on 15,000 different sports games a week for legally on DraftKings, I think we can have 2x, single stock ETFs. So I'm not a naysayer from that perspective. I mean, I don't necessarily think it's good to mix gambling and investing, but it is what it is. But the fee transparency is the real deal, right? Like when I go onto my DraftKings account, and yes, I have a DraftKings account, and yes, the Chiefs have cost me money this year, Eric. When I go out there, it tells me how much I'm risking and how much I'm going to make, and it's the VIG, right? And the VIG is real. It's usually 10%. Sometimes it's more if you're getting the hook on 2.5 instead of 3 points, whatever it may be. That should be there on these products too, because it's why when you look at these products, you can have a stock that's up 25% year to date, but both the levered and the inverse product are negative year to date. So there's the vol decay, there's that volatility component of daily reset, but there's also the fact that who's loving these products? The market makers, the APs, the Delta, the trading desks are making. We talk about go buy Virtu. That's a good stock to own. It's just there's a lot of money being made on the actual behind the scenes process of these products.